Todd, one of the more interesting flows to watch this year has been covered call ETFs. Now, these own an index like the S&P 500 or the NASDAQ 100, and they sell calls. So you get a little bit of premium and some downside protection. So these ETFs, you have them, the Global XYLD and QYLD, they're continuing to pull in money. But the funny thing is they tend to underperform in an up market, which is what we've got. So explain this to us, Todd.
They have a dual
Again,
purpose,
this is that behavioral economics problem I see here. Money keeps going in an up market.
I would love to know the demographics of who owns covered call funds, whether it's the Global X, the JP Morgan products, or other ones out there. You're getting the income, right, each month, and the protection against major drawdowns, right? Even though it's a little bit more low vol, you're going to trail in a major bull market. But that fits the profile of, say, an older investor closer to retirement, right? So I think that's the appeal of those funds for a lot of folks out there.
So you think it's not just, they're probably aware that it would underperform in an up, they just want some protection long term. They're buying like an annuity to a certain, to a certain extent. They're buying, it's not really an annuity, but they're buying some protection in some way.
Well, a covered call fund works best in a range-bound market. You're selling your upside. And you're limiting your downside to the extent the premium received from the option premium. Now, some of the QYLD, XYLD yields are in the 12% range. That's very hard to give up, particularly for an older client. But you'd be surprised. There's a lot of younger clients who are actually buying these products. If you look on Reddit and TikTok, there's kind of a cult following for some of these products.
Because the downside protection and they still have a high yield.
The yield is really the story. There's certainly downside risk.
But they do understand yields are not magic money. This is the hard thing I have explaining to people. People somehow think that, oh, I'm getting a 3% dividend yield on my stock. It's like free money, but it's not. It comes at an expense.
Of course not. There's no free lunch. But it's still hard to give up a 12% distribution rate.
That looks like an amazing number. Like it looks like free money to a certain extent.
People love income, especially when inflation is where it's at and expenses are going up every day.